Every crash I lived through looked obvious after it happened. Before it happened, almost nobody wanted to listen. And I don't say that to sound clever. I say it because I watched intelligent, experienced investors talk themselves into danger slowly, comfortably, and with great confidence. The warning signs were there. The problem was that they didn't feel like warnings at the time. They felt like normalcy. When markets are rising, people don't ask whether they're safe. They ask how much more they can make. That shift from protection to ambition is where most financial damage is done. Not during the crash itself, but years earlier when nothing feels wrong. I learned early on that my job wasn't to predict the next downturn. Prediction is seductive. It makes you feel smart, but it also makes you fragile. If you're wrong on timing, and most people are, you end up taking risks you can't afford to unwind. I didn't want brilliance. I wanted durability. So I built my thinking around one simple assumption. Bad times are not anomalies. They are part of the deal. Markets don't move in straight lines, and prosperity doesn't repeat on schedule. Optimism grows, risk hides, leverage builds, and eventually something breaks. That cycle has repeated longer than I've been alive, and it will continue long after. What surprised me wasn't that crashes happened. What surprised me was how shocked people always were. They acted betrayed, like the market had broken a promise it never made. I never expected the world to be stable. I expected it to be uncertain. That expectation shaped every serious decision I made. When others felt comfortable, I got cautious. When confidence turned into certainty, I paid attention. Comfort, I learned, is not a reward in investing. It's a warning. I saw this pattern clearly during periods when everything seemed reasonable. Valuations weren't screaming, volatility was low, the news felt manageable, and yet behavior was changing. People were stretching just a little more, taking on just a bit more exposure, explaining away risk with stories that sounded intelligent but solved nothing. That's when I reminded myself of something unglamorous but powerful. Risk doesn't announce itself. It sneaks in while you're relaxed. The most dangerous portfolios are the ones built for yesterday's environment. I didn't need to know what would trigger the next crash. I didn't need to name the date or the headline. All I needed to know was that the future would eventually be less friendly than the present. That knowledge alone was enough to change how I behaved. I kept more flexibility than felt necessary. I avoided commitments that only worked if everything went right. I accepted lower returns during good times in exchange for survival during bad ones. That trade-off frustrated some people. It never bothered me because I wasn't trying to look smart in my good years. I was trying to still be standing when the bad ones arrived. Most investors don't fail because they lack information. They fail because they confuse calm with safety and familiarity with permanence. I refused to make that mistake, and that's why, when the world finally panicked, I didn't have to. That wasn't luck. That was preparation. I also learned something uncomfortable about human behavior. The closer people get to the edge, the harder they work to convince themselves they're nowhere near it. I watched this happen again and again. The language changes first. Risk stops being discussed seriously. Words like temporary, manageable, and structural improvement start doing heavy lifting. That's when I knew danger was increasing, not decreasing. I made a habit of asking myself questions other people avoided. What happens if this assumption is wrong? What if liquidity disappears? What if fear arrives faster than logic? Those questions didn't make me popular, but they kept me honest. One of the most important decisions I ever made was to stop reaching when things were easy. When returns looked effortless, I became skeptical. Easy money has a cost, and it's usually paid later. I'd rather accept frustration early than regret permanently. There were times when holding back felt foolish. I watched others outperform me during strong markets. They looked confident, they were praised, some of them even questioned my caution. But I had already seen how quickly applause turns into silence when conditions change. I wasn't interested in being admired for 6 months if it meant being exposed for 6 years. Another thing I did quietly, consistently, was build psychological preparation. That's something almost no one talks about. People prepare spreadsheets. They don't prepare themselves. They assume they'll behave rationally under stress. They won't. I tried to imagine how it would feel to watch markets fall day after day, to open statements and see losses grow, to hear panic in other people's voices. I asked myself in advance, would I be able to sit still? Would I be forced to act? Or worse, would I talk myself into doing something irreversible? That exercise changed how much risk I was willing to carry. Not because I feared volatility, but because I respected my own humanity. I knew I wasn't immune to emotion, so I reduced the chances that emotion would control my decisions. I also learned to respect liquidity. Liquidity isn't exciting. It doesn't tell a good story at dinner parties. But when markets freeze, it becomes priceless. I never wanted to be in a position where I had to sell. Forced selling turns temporary problems into permanent losses. So I structured things to give myself time. Time to think, time to wait, time to let other people panic first. That patience wasn't accidental, it was designed. People often ask me how I stayed calm during crises. The truth is, I didn't suddenly become calm. I had already done the worrying beforehand. Panic is what happens when preparation is missing. Calm is what remains when you've already accepted the downside. I didn't assume things would work out. I assumed they might not and planned accordingly. That mindset made downturns feel less like emergencies and more like difficult but manageable environments. There's something else worth saying plainly. Many people confuse courage with aggression. I never did. Real courage in investing is restraint. It's saying no when everyone else is saying yes. It's underperforming temporarily without losing confidence. It's refusing to confuse activity with intelligence. When markets finally broke, and they always do, I wasn't scrambling to understand what went wrong. I already knew. Excess optimism had met reality. That's not a surprise. That's a pattern. And because I had prepared when others were relaxed, I didn't need to make desperate decisions when they were afraid. That's the difference between reacting to a crash and living through one with control. There's a myth I've spent most of my career quietly fighting against. The idea that the goal is to be fully invested at all times, that sitting on cash is lazy, that caution is the same thing as fear. That belief has ruined more portfolios than bad math ever did. I never felt the need to be all in. Being all in assumes the future will cooperate. I've never trusted the future enough to make that bet. Instead, I wanted optionality. I wanted the ability to move when others couldn't. I wanted dry powder not because I was waiting for a crash, but because I knew uncertainty would eventually create opportunities. You see, preparation isn't just defensive. It's offensive in a quiet way. When markets fall apart, the best opportunities don't go to the smartest people. They go to the most prepared, to the ones who aren't nursing wounds, to the ones who still have the emotional and financial capacity to act. I watched this play out repeatedly. During crises, people don't ask, is this cheap? They ask, will I survive? By the time they regain confidence, the moment has passed. I didn't want to be one of them. That's why I never stretched my assumptions. I never told myself stories just to justify exposure. I tried to separate facts from narratives. Facts are stubborn, narratives are comforting. In good times, narratives multiply. They explain why risk no longer matters. They reassure people that history has been repealed. I didn't believe those stories not because I was cynical, but because I had seen their endings. Another mistake I avoided was anchoring my identity to my portfolio. When people tie their self-worth to market performance, every downturn becomes personal. That's dangerous. It leads to defensiveness. It leads to denial. It leads to doubling down instead of stepping back. I tried to stay emotionally detached. Not indifferent, but objective. Losses didn't mean I was wrong as a person. Gains didn't mean I was brilliant. That separation made it easier to adjust when conditions changed. I also paid close attention to what people were no longer worried about. Complacency has a sound to it. It's quieter than fear, but just as revealing. When conversations shift from risk to returns, from protection to projection, alarms should go off in your head. I didn't need dramatic signals. I watched behavior. Behavior always tells the truth before prices do. One of the hardest lessons for people approaching retirement is accepting that their game has changed. The goal is no longer maximizing upside, it's minimizing regret. That requires a different posture, less leverage, more humility, fewer heroic assumptions. I prepared for crashes by respecting that reality early. I didn't wait until fear forced the adjustment. Adjustments made under pressure are usually bad ones. People often ask whether I missed out by being cautious. The answer is simple. I missed out on some upside, and I slept through every crisis. That's a trade I'd make again without hesitation, because wealth is not about peak numbers on a statement. It's about freedom of action. It's about staying in control when the world isn't. And that control is built long before you need it. Crashes don't reward intelligence. They reward preparation. And preparation looks boring right up until the moment it matters. That's the part most people never understand until it's too late. By this point, you might be thinking this all sounds cautious, conservative, maybe even boring. That's fine. Investing isn't supposed to entertain you. It's supposed to protect you. Let me clear up a few things you've probably been told that are simply wrong. You've been told that if you stay invested long enough, everything works out. That's not true for everyone. Time heals many wounds, but not all of them, especially if you're forced to sell at the wrong moment. Time only helps if you survive intact. You've been told that diversification guarantees safety. It doesn't. Diversification reduces certain risks, but it doesn't eliminate panic, leverage, or bad behavior. A diversified portfolio owned by a frightened investor is still dangerous. And you've been told that downturns are opportunities, so you shouldn't worry about them. That's only true if you're prepared. Unprepared people don't see opportunity in a crash. They see threats, and they act accordingly. What actually worked for me was much simpler and much less exciting than most advice. First, I stopped. I stopped reaching. I stopped assuming tomorrow would look like today. I stopped confusing confidence with certainty. Second, I simplified. I avoided structures I couldn't explain under stress. If something required perfect conditions to succeed, I treated it as fragile. Third, I allocated with humility. I sized positions so I could live with the downside, not tolerate it, live with it. That distinction matters more than people realize. Fourth, I protected flexibility. I kept liquidity, patience, and the ability to do nothing. Those aren't weaknesses. They're advantages when everyone else feels trapped. And finally, I accepted reality. Markets fall. People panic. Cycles repeat. Once you stop fighting those truths, you can start working with them. None of this requires genius. It requires self-awareness. It requires accepting that the most dangerous time is when you feel smartest. It requires understanding that preparation is invisible until it isn't. If you're watching this and you're uneasy about the future, don't ignore that feeling. Anxiety isn't always a flaw. Sometimes it's information. It's your mind telling you something needs to change before circumstances force it. I never waited for crashes to teach me lessons. I learned from history, from behavior, and from other people's mistakes. That's cheaper than learning firsthand. You don't need to predict the next crisis. You don't need to outthink the market. You need to outlast it. And outlasting the market isn't about courage at the moment. It's about discipline years earlier when nobody is watching and nobody thinks it matters. That's how I prepared for crashes long before they happened. Quietly, patiently, without drama. If you want more hard-earned lessons like this without the sugarcoating, subscribe and don't miss the next one.